Hello, welcome everyone to this session of the Indiana Leeds Summer Tax Workshop Series. I'm Leandra Lederman, the William W. Oliver Professor of Tax Law at Indiana University Maurer School of Law in the United States. And now I'll turn it over to my co-host to introduce himself and today's speaker.
Thank you, Leandra. I'm Dr. Leopoldo Parada. I'm a lecturer in tax law at the University of Leeds in the United Kingdom. And I have the pleasure today to introduce Dr. Ricardo García Antón, who is also a very good friend, and he's an assistant professor at Tilburg University. In the past, he was a senior research associate and a postdoctoral research fellow at the IVFD in Amsterdam. He was educated at the University of Seville, where he graduated in 2002. He holds a master's degree in taxation from the University of Seville and an advanced LLM in comparative European and international law from the European University Institute in Florence. He received a PhD from the European University Institute in 2015, and prior to that, he worked for 7 years as a tax practitioner for Deloitte, PwC, and one of the major law firms in Spain in the field of taxation, concentrated his practice on due diligence, tax audits, M&A, transactions, and tax opinions related to tax disputes. Today, Ricardo is presenting Enhancing the Group Interest in Transfer Price Analysis, a very provoking talk who is trying to cross-refer tax law and corporate law today. So Ricardo, thank you very much. And now the floor is entirely yours.
Okay, thank you very much, Leandra and Leopoldo, for this kind word. I'm very happy to be here today with you to present this paper that I've been working for a couple of years. And I think I'm looking forward to the debate, and also thanks to all the participants who are here despite the good weather and the summertime. So without more preambles, I would like to share my slides. Okay, I'm not. Yes. So how this paper started? Well, this paper started with a research question based on which are the, let's say, the branches that have dealt with a group of companies. So we have 3 branches that have been currently dealing with a group of companies. So the first is tax law, but also look for income allocation, and of course has a component of anti-avoidance. Then we have also business law, which focus is in protecting minority shareholders and creditors in related group transactions. And management control or business research would try to look for an efficient allocation of resources within a group. So these 3 branches have been said by the scholarship, by the mainstream scholarship, that are compartments. So there is no possible integration or convergence of these 3 branches on the analysis of the group of companies. So this paper is a sort of challenge of this idea that it's not possible to find a convergence within tax law, business law, and management control. And to do that, my point or my device, my conceptual device, is the group interest. So the idea is to take the group interest and try to reinforce the arm's length standard. So this paper is not a paper try to combat or struggle or disregard the arm's length, or totally the opposite. This paper try to enhance the group dimension within the transfer pricing analysis. It's nothing new in the scholarship, because also, well, Scott Wilkie have written that the BEX project was a clear attempt to take into consideration the group. We have the steps action 2, action 8 to 10, the idea of substance, the economic substance, the functional analysis. So these rules are in line to enforce a group dimension in transfer pricing. But also this paper is an attempt, I call it in the paper juridification, the idea to try to put legal frames within a discipline, that is transfer pricing, that has been traditionally neglected by lawyers because of the technicalities, and has been a field of economics. So this paper is in an attempt, or I made the attempt, to juridificate, if the word is admitted in English. So first, in order to say what's happening in a group of companies, we need to go to the theory of firm. And of course, to see the connection between the theory of firm and the transfer pricing. So if we go to the theory of firms, we can see two main trends in the analysis of the firms. So the first is the firm's authority, like was coined by Coase in a famous paper in 1937. And it's clear that these economists stress this idea of hierarchy in the firms. This idea of a strong management to reduce transaction costs and maximize profit. This idea of power is also being translated into the accounting rules, international accounting rules, but has been neglected in transfer pricing analysis. Why? It has been replaced by this idea by several economists that the firm is a nexus of contract. So every stakeholder has a sort of equality. So there is a right equilibrium with all the stakeholders in a firm. Of course, if we go to the reality, this idea of a firm as a nexus of contract does not resist the reality, does not resist what is happening after the economic crisis in 2008 and 2010. It was clear that in a firm, the important role has been devoted to the CEO, who designs the strategy. The board of directors in many listed companies is simply apply a rubber stamping functions. And it's true in listed companies, it's more important the controller, shareholder, institutional shareholder. But if this theory of firm, how it has been applied in transfer pricing? Well, it was clear that this narrative of hierarchy, this narrative of power has been completely sidestepped, and the transfer pricing guideline insists on considering the subsidiary as an autonomous enterprise. Of course, has been already criticized by Richard Bang and a famous paper of Romero Tavares. So what is happening? Why? Let's go now to business law. Why is important in this paper the recourse to business law? Because in business law also we have the legal personality principle that we can find a parallel principle in transfer pricing, the separate entity principle that is embedded within the arm's length. But in business law, and this is important, the parent company is in control and remain in control of the corporate strategy of the whole group. In business law, the subsidiary does not have autonomous power to follow the strategy. And then is introduced an ex post correction mechanism in case that there are harmful effects on the creditors and minority shareholders. But this is an ex post mechanism. So when in the first slide, we refer to business law approach to safeguard the minority shareholders and creditors, we are, in a sort of way, we are forgetting about that the main point of business law is that the company, the parent company, has the power to decide the strategy of the group. Of course, the group interest is a legal device, but has been recognized in several jurisdictions with certain degree. I call it, if we take into account what is happening in the Canadian, US courts and UK courts, of course, this idea of the lifting the veil, that is a sort of looking to the group interest, has been exceptionally accepted. US scholars also refer to the fiduciary duty of the dominant and controlling shareholder on the subsidiaries. But it's also difficult, very hard to demonstrate before a court of justice. If we go to Netherlands, and that's something that triggered also the curiosity for this group interest, in Netherlands, there is a clear recognition of the group interest in the civil code, and only very exceptional, the courts allow to give a compensation in case that the minority shareholders or creditors have been damaged by the decisions taken by the subsidiary following the strategy of the parent company. In Italy and Germany, the focus of is not so much on the group interest. The focus is on how to articulate this ex post mechanism, this ex post correctional mechanism. So the idea of this paper is just, as I told you before, the idea try to find a convergence of these three fields, trying to recognize hierarchy and power dynamics, and try to go beyond the separate entity approach. Of course, to do that, we need to first say what is the rationale? Why do we need the group interest in transfer pricing? Well, it has been always said by several scholars that group interest is exclusively grounded in the ability to pay principle. So the ability to pay principle said that you treat equally standalone companies and group companies. And also the second argument that these scholars prefer is that, well, corporate income tax is based on individual basis. But why do we need to treat not equally groups and standalone companies? First, and quantitative arguments, 60% of the transactions in the world take place within the group. So this is totally a fiction that we need to compare or treat equally standalone companies and group companies. But the second argument, well, the corporate income tax is based on individual basis, but we have group taxation. So in a sort of way, tax law recognizes the group, but also if we go into accounting rules, it's the same. They are recognizing a group dimension. But also in my view, and also the idea to enhance this ability to pay principle is still hostage of this idea of arm's length as an anti-avoidance tool that is totally against the origin of arm's length, which was a principle to distribute income among states. So this is important to enhance that horizontal equity is a principle that should play a better role in the conception of the arm's length. But also, and it's not only the group interest needed to enhance horizontal equity, but also the idea behind enforcing group interest in transfer pricing is to improve legal certainty. So we know that transfer prices is an area that is gray. There are many cases, much litigation. So the idea is to introduce this kind of rebuttable presumptions. So in a way, we reproduce the mechanics of the group interest. First, we presume that the activities of transactions follow the group interest, and only ex post, we've introduced a corrective mechanism. So the rebuttable presumptions are, in my view, the mechanism to enforce the group interest in transfer pricing. So let's just finish my presentation with 3 cases that I try to apply my theory of group interest, how it will be applicable. Of course, these 3 examples, first is the profit allocation to dependent agent enterprise. The second is the commercial rationality test. And the third is the group synergies, deal with the main parts or the main points that a lawyer needs to carry. First, how to allocate profits. And second, disregard of transactions in case that they don't comply with the functional analysis. So, well, I don't have much time to get into the details of the arguments, but what we see when the attribution of profit to a dependent agent enterprise, a DAE, we see clearly that with the example of, and I will just say the example of the low risk distributors, we can see clearly how the taxable base at source state are being continuously eroded. What is happening? Well, what's happening that Article 5.7 of the OECD Model Convention says that the subsidiaries cannot be deemed as permanent establishment. Also, the dual taxpayer theory that allows to recognize PEs without even allocating a profit. But also the idea in the OECD additional guidance that Article 5.7 and Article 9 is indifferent. What do you apply first, Article 5.7 or Article 0.9 or Article 0.9? So this is completely something that I also challenge in the article. So in my view, this idea of low risk distributor that, as you can see, are remunerated very low but very stable, also has an important issue right now with the COVID-19. As you may know, the OECD is saying, well, in the cases of a global economic crisis like the now we're living under COVID-19, we need to recognize losses in the low risk distributor. We cannot allow them to give profit, although they are, I'll say, very low profit. The president's company cannot assume all the losses. But my question, if we are saying that in that particular case, we should allocate more income to these low risk distributors. And the idea that going to my proposal is to modify Article 5.7 of the OECD Model Convention and says that, well, a subsidiary can be deemed as a permanent establishment, because it's clear that if we bring business law again, a subsidiary of this group, for instance, BMW, cannot be, is totally dependent of the parent company. So also the second part of the second point that where we can apply the group interest. The group interest can be applicable to the commercial rationality test. That is a very residual test, because as you know, we have first to apply the functional analysis. So after, if the transaction does not comply with the functional analysis, we go to the commercial rationality test. But the OECD still insists on analyzing the commercial rationality test under a standalone perspective. And of course, we go to the sample that the OECD gives in the OECD guidelines. We have a company that decided to set up a subsidiary in an area prone to floods. Well, the OECD says the fact that the premium will be so high that no one will pay it, make the transaction commercially irrational. But my question to you is like, well, this is the fact, this is the reason why we have a group of companies. Maybe there are commercial reasons that needs to justify why I decided to put a company in an area that is prone to floods. So the idea is again to enforce this commercial rationality test, and says that, well, if the group is better off after the transaction, after arrangement, the transaction comply with the commercial rationality test. And finally, if we go to the group synergies, the last slide, the group synergies is the core area of transfer pricing. As you know, the OECD traces a distinction between incidental profits, incidental support, and deliberate concern actions. Well, you know that implicit support, there is no remuneration, while when deliberate concern actions, there is a remuneration, compensation. Well, from the legal point of view, and this is the reason also this paper tried to juridificate this area, when we go to the reading of the case law, it's very, very difficult to distinguish which is implicit passive association or deliberate concern action. It's really difficult to prove. So the solution maybe will be again a rebuttable presumption. A rebuttable presumptions that try to say that, well, these transactions in the group are considered that derived from the implicit support, from passive association. But the burden of proof changes. If the taxpayer or the administration want to change it, well, prove it. So finally, this idea that I want to say here today and also discuss with you is that, well, we need first to introduce a standard of horizontal equity within the arm's length. We need also to introduce more legal certainty in the discipline. That I think that's the key element device is the introduction of these rebuttable presumptions. We have seen how this group interest can be applicable in these three areas to reinforce the group interest and the group dimension of transfer pricing. So with that, I just stop sharing my slides. I will give you thanks everybody to attending this my presentation. I'm looking forward to your question and debate. Thank you very much.